Hi, everyone. Welcome to our DAT IQ Weekly Market Update. This is our update for September 10, episode 307. I'm Dean Croak, Market Analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy. Special guest today, Tim Denoyer. Good morning, guys.
Good morning,
Dean.
How are we today?
Pretty good. How are you?
Yeah, can't complain. Not happy that summer's ending. It seems to be straight after Labor Day in the Northeast. Things change dramatically, so fall is here.
We've got summer for another month or two down here in Florida, Dean. You can join us if you need to.
I was reading this morning, Chad, that I was thinking about how quiet the Atlantic hurricane season's been down your way, but then Mansfield Oil come out with a report this morning that says that experts caution the season's peak is still ahead. 40% of tropical storm activity historically occurs after September 10. So we've still got a ways to go.
Yeah. I know, was it last year we had the latest storm ever?
Yeah. The flatbed market's looking eerily like 2017 when I think it was Irma and the other one, I can't remember, the other Cat 5 came in. But we're seeing data start in flatbed in particular line up with 2017, which it may be just coincidental, but we shall see. All right, Tim, tell us a little bit about what you do in ACT Research for those that don't know you.
Sure, absolutely. My name is Tim Denoyer, VP and Senior Analyst with ACT Research. Our firm is a commercial vehicle data analysis and forecasting shop, essentially. We do a lot of consulting with fleets, manufacturers, dealers, lots of different suppliers and shippers around the industry, different players. And basically, we try to work closely with companies like DAT and keep a good finger on the pulse of the market. One of the really unique things about our business is the supply side of the industry. We work with a lot of manufacturers' data, a lot of used truck price data, that type of thing that we sort of bring to the table, if you will.
Fantastic. We had a lot of questions for you. We'll come back and talk a little bit about some of that new truck order data, including some questions I think we've all got about EPA regulations coming down the pipe, literally, or out of the pipe, as it would be. All right, we'll bring Tim back a little bit later, and Chad, let's dive into the market update and look at some of the key trends we're watching. Spot rates up substantially last week. When I say substantially in flatbed, higher than they would normally rise in the short work week after Labor Day, but dry van and reefer were flat. August dry van actuals, we're now 2 months into the next cycle. The spot rates have trended north of 5% positive year over year for the last 2 months. That's an interesting trend. After 20, I think it was about 27 months of contraction, that was preceded by 22 months of fairly extreme expansion. So as Ken Adamo put in LinkedIn last week, the obituary for this last freight cycle was about 49 months, quite long. ISM PMI, manufacturing contracted in August. New orders, though, more importantly, dropped further into contraction, down 6% month over month and roughly the same year over year. Zach Rogers' LMI came out last week after 3 months of contraction. Inventory levels are moving back towards expansion. What Zach suggests is that a lot of these imports have been coming into the ports, have been sitting around somewhere close to the port of entry and haven't been shipped down to retailers yet. Of course, that's normally what would happen as we head into peak shipping season. Operating costs in last week's weekly update, we looked at operating costs for small carriers. National average is sitting at about $1.79 in August. That puts carrier profitability, when you think about spot rates at $2.01, lower than where it was in 2019. So current market for small carriers, financial viability is the worst since the last bull market in 2018. In this week's market update that'll be published this evening at dat.com/market update, we're talking with DAT's Chief Security Officer, Erica Voss. Really interesting discussion about how to think about fraud in the trucking industry. We've got some more details on the ISM PMI, plus a deteriorating outlook from restaurateurs, which impacts the refrigerated market, and of course more on Zach Rogers' LMI. All right, let's start with the load to truck ratio in dry van. Number of load posted was lower than last week. Of course, it's a short work week after Labor Day, so the numbers are way down. The net result of carriers taking time off after Labor Day was the load to truck ratio down about 2 percentage points. Not a big shift. Ended at 3.84. In a refrigerated market, load post lower also. They're about 31% lower than last year, though. More importantly, produce volumes are down substantially, so that's putting a drag on the produce market, reefer sector. Load to truck ratio down 10% to 5.74. And in flatbed, again, load post volumes down substantially, about 37% lower than the long-term average for week 36. Load to truck ratio was up 17% to 12.16 last week. A lot more carriers took time off last week by the looks of it compared to dry van and reefer. Having a look at our year-over-year look at spot rates, dry van line haul rates dropped a penny per mile last week, sitting at about $1.62 a mile. Remember, that's excluding fuel, so this is line haul only, with a 25% decrease in the volume of loads moved, again, during a short week, so we shouldn't read too much into that decrease in volume. At $1.62 a mile, rates are about 2 cents a mile higher than last year and about 3 cents a mile higher than the 3-month trailing average. And compared to the top 50 lanes based on loads moved, they averaged $1.99 per mile last week, 37 cents a mile higher than the $1.62 national average. In refrigerated, as summer comes to an end after Labor Day, the increases in produce volume start to dissipate that we typically see in that lead up. Rates began to decrease last week, as they do seasonally, down 2 cents a mile to $1.99. The national average is about the same as last year and about 4 cents a mile higher than the long-term average for week 36, excluding the pandemic impacted years. And lastly, in flatbed, capacity tightened significantly last week, going against seasonal trends. Rates are up 3 cents a mile to a national average of 201. In contrast, the load volume dropped by about 40%, much more than the other two equipment types in the shorter work week. Load post volumes also down 11% last week. Compared to last year, rates are about 10 cents a mile higher for flatbed carriers, about 12 cents a mile higher than in 2019, and 2 cents a mile higher than in 2017, and following that year when Hurricanes Harvey and Irma made landfall around this time. All right, so let's have a look at our forecast. You'll notice we've got a new forecast format this week. We're using our flagship Ratecast in green, which is predicting what rate view will be 35 days out, more heavily weights long-term seasonal trends. The forecast is bounded by the upper and lower forward-looking error bands, exactly as it's displayed in the Ratecast product. The blue line, of course, is the rolling 7-day weighted average of historical rates. These are for loads moved over 550 miles, excluding fuel, so line haul only. Let's start with dry van. National average long haul rates are forecasted to peak at the end of the month before regressing slightly. The net is Ratecast is expecting rates to be flat out 35 days to about the 10th of October. The upper band is expecting a 7-cent lift, while the lower band is forecasting a 7% decrease. Ratecast is notoriously accurate in this time range, so I think we're looking for a flat rate outlook, as we've been pretty much saying all year. In the tent control sector, there's a softer outlook in the lead up to Thanksgiving shipping in early November. That coincides with the start of Christmas and fall produce seasons. We expect seasonality to emerge at the end of this forecast range and lift rates beginning 3 weeks out from Thanksgiving. That's what normally happens. In the interim, Ratecast is looking for a 5-cent decrease through early October, in line with what we normally see in the market this time of the year. And lastly, in flatbed, we're seeing a lot more optimism in the Ratecast forecast. It's looking for a 2-cent per mile lift out to the end of September before drifting back by about 2 cents by mid-October. So again, essentially flat out 35 days. Over to you, Chad, for what you see in the shipper contract market.
Yep. So as a reminder to our listeners, everything that Dean's covered is from a broker to a carrier perspective, and everything I'll cover here is from a shipper to carrier or broker perspective. Starting out with our spot premium ratio for dry van loads, we're looking at a spot premium ratio of negative 8.7%. What that means is spot rates right now 8.7% below contract rates on the shipper side for dry van. So still depressed market, been depressed since April of 2022. So longest trough ever. Moving on to new rate differential. New rate differential is the percentage difference between new contract rates that we detect coming in from our contribution data and those rates that replace them. So we see a possible green shoot there of a positive number, 0.6%, new rates coming in slightly higher than the rates that they replace. So that could be a good sign for carriers and for brokers. But it is a green shoot. It is our last data point, so it could get corrected as more data comes in. Let's move on to contract rate index. So this measures the relative change to our 2016 model, so our 2016 index. And you can see that we're kind of just bouncing around the trough of the bottom of the market there for quite some time. And we'll move on to reefer rates, where you see a spot premium ratio at negative 10%, still quite depressed. A little bit of a green shoot there, 2 weeks in a row at 1.4% for the new rate differential. So new rates coming in 1.5% above the rates that they replaced on the contract side. And that contract rate index still bouncing around that trough at 20%. And finally, to wrap it up on the flatbed side, a lot of volatility there in the spot premium ratios we expect with flatbed, and have always seen new rate differential still at negative 3%. And contract rates continuing to bounce around the bottom. That's everything from the shipper side.
Thank you, Chad. All right, so let's bring Tim back in. Tim, question of the week. Your freight market outlook has been more bullish as the year progresses. How are you seeing the rest of the year and the start of next year?
Yeah, that's true. That very much, we've gotten a little bit more optimistic in the past few months. I think maybe to put a little bit more context on where we came from, I think I've been pretty cautious about the freight market over the past year or so, because we've seen a lot of excess capacity being added at the manufacturer level. There's been this, we talked about it the last time we were together. There's been a lot of demand for equipment, mainly tractors that there's some pre-buying going on ahead of 2027 emission standards. There's still some replacement going on from a few years ago. There's some insourcing also going on with private fleets, and so all that has led to really strong equipment demand. And that's, I think, one of the main factors. There's a bunch of a lot of factors, but I think that's one of the reasons we've had such a long downturn. And one of the reasons we've gotten more optimistic over the past few months is that we are seeing signs that this is sort of running out of steam, and the manufacturers are having a tough time filling the rest of this year. We heard that at our seminar. At current build rates, so build rates may need to come down a bit further. Tractor retail sales have hung in okay. There's been some noise recently around that CDK hack, and so June went down and July bounced back. But we've been heading towards replacement. We're still adding a little bit to the fleet overall, and so that we're not quite at a place where capacity is starting to tighten yet. But inventories are starting to build up at the dealers, and orders. Order backlogs are pretty thin right now. And so you can get a truck in a relatively short amount of time. But order season is just about to open up here over the next couple of months. And so the next few months are really key. And so that's, but they're, we're coming from an interesting situation. If we see some big order numbers in the next few months, my optimism may prove wrong. But I do think that there's a bit of a shift happening, and I think the election is a decent piece of it. And regardless, we don't have to delve into politics too much, but I think just going into a period of uncertainty here, of elevated uncertainty, like you'll see in broader, new orders indexes for PMIs and things like that, you'll see some uncertainty weigh on those things in the months leading into an election. And so I think that's where we find ourselves, and that pause, it really could help the freight cycle to move into that more early cycle stage that we've been waiting for.
When we were in Columbus at your seminar last month, you were talking about private fleet new orders starting to cool off. Is that a trend that's been sustained?
So far, but order season doesn't really start until September, and September, October are the two, generally the two first months of it. This year, I think it's going to be delayed. So I don't think we're going to really have a great answer to that question, probably until early next year, frankly.
That's
it's going to take some time. that just timing lag where, coming into it, there's not really much in the OEM's backlogs, and the inventories are piling up. That does suggest that the supply is going to start coming down finally. The OEMs have been really trying to tread water at a high level because they know demand in 2026 is going to be really strong. But 2025 is just, the setup isn't quite there, and I don't think there's a lot of demand sort of early next year for new equipment. And I think that's going to force some tough decisions by the manufacturers.
Tim, following on from that, for those that don't follow the market, why do order books open in September?
It's an annual cycle. Typically, there's some big conferences actually in October, like the ATA conference is coming up in a few weeks. I don't know if you're heading down to Nashville. I am. But there's some of these conferences where some of these orders take place, and that's or at least discussions and those kind of things. And a lot of these talks are happening. The planning cycles are pretty long, but there's the final decisions tend to start at this point in the year as the fleets plan for the upcoming year, and that's really just the way it's always been done. And in really strong years, you'll see when demand is extremely strong, you'll see the order season open up even earlier, because, when the OEMs have sort of recognized that. And at this point, we haven't really seen it. We just got August orders just the other day, and I believe Class 8 was about 16,800, which is anything below 20,000 is sort of a below replacement number, but that's normal for August. August doesn't. I think it seasonalized up to like 18 something, so it wasn't. It was still a soft number, and we've had a number of soft numbers for the last 6 months or so. But that's typically what you expect, in the first half of the year. We're just getting into it, where it's going to get interesting here, over the next 3 to 6 months, really.
Got it.
So Tim, overall, your assessment is there's excess supply in the market. Is that how you summarize it? But when we do sell off used trucks, where do those go? I know in prior soft market cycles we would sell off to the BRIC countries. Is that still the case?
Not as much these days. No. Actually, I've got that on my desk. About a little over half of the stuff that we export actually just goes right to Mexico. The rest of it kind of goes down to Central America. Guatemala is a big importer. Canada is another one who's at the top of the list these days. We still export a little bit overseas to Nigeria, and some to Vietnam, but there's really not very much going overseas anymore. It's mostly heading down to Central America. And we do we're estimating this year we're going to export about 20,000 Class 8 tractors, which is a little bit of an above average year. It's cooling off a little bit at the moment because the peso has really made a move here since the Mexican election in the past month or two, and it had been really strong, and it's weakened by about 25%. It's been a huge move. So their ability to buy American trucks has been considerably reduced for the short term anyway. So that probably will, those numbers probably will to come down a little bit, unfortunately. We like to track those numbers because that's one of the ways that we help model the overall fleet size, and they do tend to be older tractors that we export, but
that makes sense that the demand would be there. I think post-COVID, there's been a near-shoring trend into Mexico, so it seems that the demand would be there. Makes sense.
New truck demand has been really strong in Mexico too, and we feel that market from a new truck perspective was really underinvested for a long time, and you're seeing it now the last couple of years. They're actually selling a lot of new trucks in Mexico now too, which is an interesting trend.
Tim, how much are EPA type regulations south of the border impacting that?
That's a fair question. I can't say I know too well. I mean, what I would suggest is that. I know that the regulations are not close to the U.S. and Canada. I think the U.S. and Canada are on similar emissions regulations, but Mexico does not tend to follow too closely. So I think they could run into challenges with their diesel fuel at some point, but I'm not. I can't say I'm an expert on that. But
all right.
Tim, from the conversation a little earlier, it seems like, would it be fair to summarize that government regulation is creating some pre-buying activity which is continuing to inflate this excess capacity situation that we have. What are those specific regulations that are pushing the pre-buy?
Yeah, it's a great question. Maybe to finish that point a little bit, the reason, to come back to the question of the day, the reason we've gotten more optimistic is that pre-buying seems to be going into a bit of a lull. And for-hire sector has definitely reduced their capital spending, and it looks like the private fleets are at least cooling off a bit. And so while I think we still expect private fleets to grow, we expect these capacity additions to cool off, I think is the short-term outlook. We think they're going to probably heat back up at some point, but most of these regulations take effect in 2027. The biggest one from a cost standpoint is it's called EPA Clean Truck Rule. It went into effect, I believe it was finalized in 2019, and that is going to raise the cost of a Class 8 tractor by something like 10-12%, and operating these trucks is going to get considerably more expensive, because obviously financing that and insuring that, and there's a lot of different related costs that are going to be a big challenge for fleets in 2027. And typically with these emission standards, sort of like the question is, what do we get out of this? And for the last decade or so, we've gotten some pretty big fuel economy improvements, which has really gone a long way to say, hey, you can raise the price of a truck a few $1,000s for getting this fuel economy. That's great. That's really been the story, since SCR in 2010, which was the last one that added a lot to the cost of a truck without really helping fuel economy. That one didn't hurt. The 2027 one, it looks like it may be roughly neutral from a fuel perspective. It's hard to say exactly, but they are going to try to at low loads to heat up the SCR systems a little bit more, and that does take fuel. So SCR systems don't really work wonderfully when they're not at highway speeds. So for things that are running at slower speeds, there probably will be some fuel cost. But anyway, it's most of the cost is actually going to be warranty and useful life improvements, and so some of that does accrue to the fleet a little bit. Should hold up a little bit in the used truck market. Historically, emissions related stuff doesn't hold up wonderfully in the used truck market, as you might imagine. The secondary buyer doesn't care too much, but I will say one other thing that's got our optimism improving this year. We don't usually use used truck prices as a leading indicator. It does tend to lag, but just looking at the way the used truck prices have trended this year, it's been really solid and resilient, and surprisingly so. Obviously, we've come way down over the past couple of years, but that downtrend seems to have ended.
Tim, anecdotally, a lot of that's because of the fear of what the clean truck rule will do to trucks. I think we talked about this in Columbus. A lot of my friends in the owner-operator world are desperately looking for low-mileage used trucks that don't have the new emissions on them, just for fear of the unknown. What will the cost be? And I think more importantly, though, what's the longevity of these new designed engines? Will they last? I think that's the biggest fear. Tim, just before we wrap up, talk a little bit about new trailer orders. What's the trend there?
Yeah, new trailer orders have been pretty soft. It's with an industry that's sort of broadly struggling financially. If you look at the for-hire sector broadly, it's been a rough couple of years, and there is all this focus on buying as many tractors as you can. Trailers obviously kind of lose out, and when there's limited capital budgets and there's a lot of focus on tractors, the outlook for trailers isn't wonderful. Reefer trailers is one place where we're a little bit relatively optimistic, but even that it's maybe going to hold on to replacement type levels in terms of new trailer demand. So there's a fair amount of longer term reasons for that, but yeah, dry van demand is going to be pretty soft, and we've tended to be lowering our dry van trailer forecasts as the impact of these regulations becomes more clear.
Yeah, it really makes your point about maybe October, November new truck orders being very, very indicative of how truckload carriers are thinking once those order books open up. I think those year-over-year comps will be very interesting.
Absolutely, it's it's going to be that's going to be a key, and it's the private fleets as well as the for-hire fleets. I think we understand the private fleet, what the for-hire fleets are doing pretty well, and that they've been, the numbers are generally out there. They've been contracting from a capacity perspective for some time. So there's private fleet additions that we think are going to stop relatively soon. But we'll see.
These are interesting times. Tim, thanks for that update. A couple of quick shout outs before we wrap up the show. On Freight Vine podcast, Chris Kaplis is talking to Alex Scott from the University of Tennessee. He helps companies benchmark carrier carbon emissions. That show was out last Thursday. Don't miss it. We've also got DATCon coming up, where Tim, Chad, and myself will be there. Of course, along with a lot of other people from DAT and our customers, October 22 to 24 in Kansas City. Go to dat.com/DATCon to register. I'll be on Radio Nemo with Jimmy Mack this Thursday at 8 a.m. Before we wrap up, Tim, how can people contact you?
Yeah, you can find us at actresearch.net, and I'll give you 2 pieces of free research. I write the CAS report each month at CAS Information Systems website, and you can always sign up for our for-hire index. We have a monthly survey of fleets, and we do send out that to anyone interested.
Excellent. All right, good. Also, don't forget, next week is National Truck Driver Awareness Week, 15 to 21 of September. Time to pause and honour the backbone of our industry, our nation's truck drivers. Make sure you set up alerts for today's show. Subscribe to the channel. And with that, another show is in the books. Be safe, be nice to everyone, and we'll see you back here next week at 10 a.m. Eastern, 7 a.m. Pacific.
Good night.